Okay, everybody, thank you for joining. Welcome, everyone. I see we still have a bunch more people who are signing on right now, but we can go ahead and get started so we can leave plenty of time for Q&A and also to hear from Scott Singer, who I know many of you are certainly anxious to hear about his thoughts on the debt market, certainly a big driver in everything that's going on right now. And then Brent Glodowski as well, who heads up our retail sales for the Tri-State Investment Sales Group, and a little bit of a bright spot there with the interest that we've seen in the retail sector of the market. So we wanted to share that with you. So for those of you who don't know, I'm James Nelson. I'm principal and I'm head of the Tri-State Investment Sales Group here at Avison Young. We have close to 36 people in our group here, and have a great team who helped prepare this information. So we're looking forward to sharing this. So I see Scott has just signed on, and looks like there's Brent as well. So good, perfect. And gentlemen, if you want to interject, feel free to as well. But we'll go ahead and get rolling here. So let's talk about what happened for investment sales in New York City this past quarter. You can see across the city, there was a total of $5.2 billion in sales. So yes, we did see a 16% decline over the trailing 4 quarters. So at this point, it looks like we are on pace to do $24 billion of sales with an average of $35 billion comparatively for the 10-year average. So certainly you could see on one hand, we've looks like we'll make a decent jump from 2021, where last year it was $15.4 billion. Not much to write home about, but yes, we are seeing an upwards trajectory, and we hope that continues with the headwinds that the debt markets are now providing. So when you look at what is happening in the various boroughs, Manhattan, $3.5 billion of sales. And again, we're talking about multifamily, retail, office, and land over $5 million. And with retail, we look at sales over $2 million. In Brooklyn, you see an uptick of 6% with $1 billion of trades last quarter, and Queens down 15%, $437 million. The Bronx with only $73 million in trades. It's a drop of 74%, and Upper Manhattan as well, seeing a pretty significant decline with only $89 million in sales. So, and by the way, if you do have questions along the way that you want to ask, feel free to add those in the chat, and we'll see if we can get to those, or excuse me, in the Q&A box. Okay, so as far as the number of sales for New York City, we experienced 141 trades this past quarter, which is, if you annualize, that's 589 sales, about half the annual 10-year average of just over 1,000 sales. So you can see that the number of sales was down in Manhattan, Bronx, and Upper Manhattan, but Brooklyn actually had an uptick in the number of sales, as did Queens. So it still amazes me whether, we end up at 500 sales, or even, you look at the 10-year average at 1,000. I always get asked the question, is it is a seller's or a buyer's market? When you only have 1,000 properties on average that trade per year, it's still a competitive market. So I find that interesting that there's only so much of the inventory that turns over every year. So now we'll look at what's happening in each of the asset classes, which is multifamily had a very strong quarter with $2.2 billion in sales. That was a 51% uptick from the trailing 4 quarters. You did see a drop in the number of sales at only 36. So these were more significant sales that were taking place. And we did see an uptick in cap rates. So we're already seeing some upward pressure on cap rates, meaning downward pressure on pricing. So the average cap rate in Manhattan for an apartment building is now 4.78%. But the average price per square foot went up by 27% to an average of $982. Now, as you know from listening to this in the past, green arrows are generally good. That means things are moving up. Red is generally a negative, meaning that things are declining. So we have, over these 36 sales, some mixed messages that are taking place here between the average cap rate and the price per foot. So, the sense we have here, if you look at these higher quality assets, yes, they are trading, giving a little bit more yield, but they're also generating higher prices per foot because they're better quality assets that are trading. So that is my explanation for that. And if you look at where this year should shake out, right now, the average multifamily cap rate has been just below 4.5%, average price per foot at $872. So you certainly see some cap rate expansion. Now, Scott's going to get into this. I'm sure Brent's going to get into this, but it is important. And I should have reminded you all right from the start that this is a rear view indicator. Okay, so we are reporting on sales which closed in the third quarter, right? So we can talk about July, August, September, but remember that those deals that closed in those months were negotiated in many cases 60 to 90 days before. So we said this on the last webinar that we did, and what we were just then experiencing were these rate hikes that began to go in effect in June. So a June rate hike, if you signed a contract later in that month in June, that sale, unless if it closed in this last quarter, might not have even registered. And that's why we have been saying that the full impact on pricing, on volume of this recent run up in rates has not been felt by the market. So we probably should caveat that. And when we talk about upward trend and trajectory, like I said, it's going to have a challenge keeping up with this respect. But I do think multifamily, you take a look at the amount of product that's sold, and certainly you have a lot of this institutional product trading. And if you look at 19 Dutch Street that sold for $500 million, 160 Riverside Boulevard at $415 million, and 685 First Avenue for $387 million. These are large ticket sales that have taken place. And it's interesting. It's mostly, we get asked the question a lot, is it institutional buyers? Is it foreign buyers? What you see here is a little bit of a mix of all of the above. So you have a foreign group that purchased 19 Dutch. You have 160 Riverside Boulevard that was purchased by A&E, which has been a very active local operator. And here you have, again, another private operator in Black Spruce and Orbach who purchased. This was part of the solo multifamily buildings that sold. So now we'll move on to land sales, and we will see that it does appear that the price per square foot, price per buildable square footage is going up. In fact, in this last quarter, the average was 532 a buildable foot, although there was only 7 sales. So sometimes it's difficult to read too much into averages when you do not have as many data points. What I can tell you about land sales is because of the expiration of the 421A, we're not seeing a lot of sites being sold for rental. So again, why has land gone up by over a third over the last year? Well, yes, if you look at the averages, but I think the big reason there is because the majority of these sites that are being sold are for condo. So here you can see some of the different trades that took place. 570 Washington. This was a massive site down in Hudson Square, and you had Atlas Capital join, I believe, with the Zeckendorfs to acquire this site. You have a development site here on the Upper East Side that was purchased, as well as First Avenue. I believe all these sites, if I'm not mistaken, were for condo development. So next we talk about some of the office sales which have taken place. Here we have seen a big decline in dollar volume and the number of sales. Well, more so the dollar volume, down 63% over the trailing 4 quarters for a total of 9 sales. Average price per foot at $977 a foot still has seemed relatively stable. You look at the average cap, still in the mid 4% range. Average price per rentable foot just above $1,000 a foot per year. But again, we are not seeing a lot of sales that are taking place here. I mean, you look at the average deal size here, 745 divided by 9, is a little over $80 million on average. So these are not the big trophy office deals, the billion-dollar trades that really drive the market. It's been a little sleepier, as a lot of the investors you could see are shifting more towards multifamily. So again, the multifamily dollar volume was more than double, actually almost triple what office was. So I think that's pretty interesting and telling. So you look at some of the trades that did take place, and interesting here that the first one at 95 Morton that RFR sold to Meadow, this was mostly occupied. So here, this would really kind of characterize this more of a core deal. But then on 61st Street, you have, I believe it was HSS, or excuse me, Mount Sinai, that purchased this for their own use. You all might have also read that Mount Sinai also purchased the base of the Lipstick building. So interesting that you have end users now stepping up to take down large vacant office buildings or portions of them. And then lastly, 45 East 53rd Street. This is right off of Park Avenue. Bank of Santander was the tenant. They were the sellers. And ultimately, excuse me, they were not the sellers. They were the tenant. They were leaving. And so this was Rialto that bought this as vacant. So, we do see some instances, certainly for prime locations, certainly off Park Avenue, where buyers are willing to stretch and take the risk. For vacant buildings, we have not seen this as much when you go kind of further into the Class B and C space, unless if these were end user sales, as stated here with 61st Street. So I do want to talk a little bit about the return to office, because that tends to get the headlines. And the stat that you all have probably heard is this 47%. So when you talk about a 47% return to office post Labor Day this year compared to post Labor Day before COVID, so going back to September of 2019, 47% doesn't sound so great. But what I really want to stress to you all, because it's not just the return to office, it's, where are people living now? Where are people shopping? Where is the activity? And, again, I think you can glean a lot from these numbers, which is, yes, if you average the whole city, it's at 47%, but it's very different based on where you go. So the East Village and Soho have over 70% return to office in those markets. Obviously, Meatpacking, Tribeca are showing strong growth as well. And yes, you see the financial district is having some challenges down here, even Hudson Yards, and I would imagine some of those areas you certainly have more tech tenants who might still be working remotely or hybrid. So we hope that those will continue to come back. There has been a strong return from finance, obviously real estate. Law firms are starting to utilize space more. And I think the last thing I would say on the return to office is it's so specific, not just to the submarket, but also the quality of the building. There's the LMI survey, which studies the quality of the building, and they took one tenant who was in the same market across 3 different buildings. One was a Class B, one was an A, one was a trophy. Not only was the Class A trophy, but it was also LEED certified, certified wellness. And what they found was that the return to office was far greater in that the highest quality building. So that's interesting, that it's about the neighborhood, but it's also about the quality of building and flight to quality, if that's what you want to have your workers return. The last thing I want to talk about for office is really the need to convert a lot of this office space to residential. So the availability rate is now around 20%, which is about 100 million square feet available in the city for lease. And look, some of this office space, whether it's Class B, C, is obsolete now. And we need to come up with a plan. When I say we, it's the city, it's the state, to figure out how to allow for office to residential conversions. It's challenging because a lot of these buildings, the way that they are built full on the lot, are not conducive from a light and air standpoint, but also many of them are in manufacturing districts which do not allow residential. So we're working with the real estate board in New York and trying to figure out ways where we can facilitate office to residential. And what we are hearing from a lot of our clients and office owners is the numbers just do not pencil unless there would be a tax abatement. And as you all know, we're still waiting for 421A to come back in its latest iteration. So hoping that Albany can act on that, as well as come up with a program that makes it more enticing and more feasible for office owners to convert to residential. So that will be the topic of my white paper for next month. So certainly keep a lookout for that. Okay, Brent, over to you. You're going to talk a little bit about what you're seeing out there for retail.
Thanks so much, James. Good morning, everyone. Hope everyone had a nice weekend. Again, thanks again. So next few slides, we'll talk about what we're seeing in retail, which, effectively was a bit of a four-letter word, even pre-COVID, and then of course during COVID. But we're starting to see some green shoots in the market. It'll be really interesting to see how the market plays out over the upcoming quarters. But here's a little bit of an overview of what we're seeing. Volume is slightly up, as well as cap rates from the previous quarter. Very interesting here. Taking rents are up for the first time since 2016. So that's an indicator, I think, of tenant confidence. Again, it's an indicator that we're, I think, through the bottom of this market. It'll again be interesting to see how things play out over the next few quarters, as there's now kind of a bit more confidence and stability in the rental market. Biggest issue we're seeing, and I know Scott's going to touch on this, is rising interest rates. Huge factor facing retail in what you can borrow. This particularly affects retail condos and properties that have one or two tenants. I think, when we're seeing trades, and I think what we'll see in the next few quarters is many of these trades are going to be multi-tenant trades. If you've got one or two tenants in your space and a tenant goes sideways or a tenant leaves, the transaction can really, be stalled or go backwards. So, and that's plays in very heavily with interest rates. Who's buying? Cash heavy families are buying. They're buying very selectively, very discernibly. And of course, 1031 groups are buying because they have to, because they need to put the money to work. Just some statistics here. And again, these are trailing fourth quarter averages, and just looking at Manhattan. Total volume is down 20% from last quarter, 121 million. Number of sales are slightly up, 14. And the price per foot is down, $1,000 to $1,000, basically $1,000 a foot, down 45%. That can kind of be a little bit of a not telling story, just because each retail condo, each submarket is so very specific. You look at an area like Soho, for example, price per foot on Broadway can differ drastically from, say, Spring or Prince Street. So with retail, it's always, kind of always trying to thread the needle with some of these metrics, but just good things to be aware of. Cap rates are up. 6.16% is the average cap rate. If we look at just the last 10 years, this is at its highest, and price per foot is at its lowest, $1,400 a square foot. So very interesting to see that relationship there. Again, I think we'll probably see that that continue to spread over the next few quarters, as rates tick up, but will be interesting to see. A few retail sales of note: 897 8th Avenue, $35 million. Again, this was a multi-tenant asset. As I mentioned, I think we're going to see more of these trades. Again, multi-tenant is easier for, I think, a lender to get comfortable with. 230 Barrack Street, and I should mention the buyer of that is a family office who's been very active in the city. Same with 230 Barrack. This is also a family office, multi-tenant asset here, down in a little bit more of a prime location. 897 8th was in Chelsea, and 1330 Broadway. Active investor here purchased this. This was interesting that it was purchased vacant for 9.7. Previously, this was asking a much higher number, so maybe a little bit of distress in that one. But this lays out very nicely for a single tenant operator. And again, this is Broadway in the 40s, so very prime location there. And I'm going to kick it over to Scott, who will discuss the debt markets.
Yeah, and just to wrap it up on the investment sales side, and hopefully this is what Scott will be answering is, when will we see interest rates begin to stabilize? So
Oh,
I know he's going to love that question.
Yeah, you snuck that one in on me.
And we talked about this office demand and the return to office, so we'll continue to watch that. And then we're also going to keep you posted on this conversion of office to residential, because we think that could be really a great solution to these challenges. Okay, Scott, you're up.
Terrific. All right. Hi, everybody. Glad to be on. When are they going to stabilize? I'm going to try not to prognosticate, but focus more on what if. And I think the good news from my perspective is that we're in the market with a lot of deals now, and we are getting proposals on everything that we have out there, and it ranges from across property types, including development, land. There is liquidity in the market. I would say there is a very, very strong desire on new deals to close in 23, not 22. And I don't mean to be Pollyanna. It is certainly challenging, but it is still a liquid and functioning market. I'm going to revisit my slides from our last quarterly update, or the last one I was on, which was first quarter this year. So James, if you can hit one forward for me. So the handwriting is the changes to the slide from last time around. So when we did this last slide, we were looking at a treasury that had hit 285, which sounded high, and borrowing rates were on some deals hitting 5% for the first time in a long time. And the question was, should I refinance? I think now, with what's happened since then, in many cases, the question has become, can I? And if I can, is it advisable? And I'll come back to prepayment and circle back to prepayment penalties, which is interesting. We can go to the next one. We put together the longest term or longest duration look at treasuries that we could find, which goes back to 1962. And look, we're all trying to figure out, where are we going now? Where are we going next? But it is interesting to look at the very long term. I was surprised, frankly, at the rates in the 60s. I didn't realize they had ever been as low as 4% at the very left of this graph. And I think the last time around we focused on 1994 forward, which was when my career started. But this is an interesting. It is an interesting graph. If we go to the next one, again, looking back to our presentation in April, the argument we were making then was that 2.87, I guess it was on that day, wasn't so bad. And I think in hindsight, that sounds right now. I think if anyone who could borrow based on a 287 treasury today would be highly likely to sign up. And at that point, what we were focusing on was the second point at the top, which was that happened to exactly equal the average treasury from 2006 to 2020, which was this low period in the market. So even though at that point 287 was sounding very high, from that more recent historical standpoint, it was at an average. Now, if we look, and again, this is the slide from the last time around, but I think on Friday, maybe we're up to 390 today, but the treasury where it sits today, 10-year, is still at an average that at the average of my career for what it's worth, and I'm getting a little long in the tooth, but still, as we think about, wow, the Treasury is hitting 4, has this ever happened before? The answer is absolutely yes. We've had many environments where treasuries were higher than this, and again, over a, let's say, charitably, a 25-year period, that we're still only at the at that average. So if we move on to the next one, James, it's so this is something that so I have often talked about the fact that LIBOR moves really quickly, and LIBOR now it's SOFR, but the point is short-term rates, when they move really far and really fast. Jeff Morak gets the credit here for finding this and putting it on a graph where you can see it. The pink, more jagged line is, or more consistent line, is 10-year treasuries since 1989. And the blue line with the big ups and downs is 1-month LIBOR over that period of time. What I see, not an economist, but when I look at this, what catches my eye is the amplitude of the changes. There have been, since 1989, 3 rapid decreases in short-term rates that were more than 6% in change. So at the very beginning of this, from 9% down to 3% in the early 90s, in around 2000, it's really around 9/11, from almost 7% to almost 1%. And again, in the beginning of the great financial crisis, from 5.5 down to, close to 0. So what does that mean? We couldn't get Bernanke or Powell to come on with us this time, but it's what I see is very short periods of time at the highs in short-term rates and rapid declines. And what does that mean? It seems to me that means it's politically difficult to hold short-term rates high for extended period of time. Where is the top? That's obviously a very big question now. And that brings us back to, James, if you go to the next one, in this, and I tend to focus on longer term borrowing, although we do a lot of development financing, but in this longest duration look at treasuries, where are we? And I think that, and what's going to happen next. So I'm looking back to, why are rates going up now? Rates are going up now because primarily because the Fed is trying to stop high inflation. And there have been various raises or increases in rates over the last 25 years. But the last time that the increases in market rates were driven were being pushed up to try to combat inflation was the late 70s. And so, James, if you go to the next one, I'm sort of when I look at, okay, where are we and what's coming next? These 2 periods of time look uncomfortably similar to me. And so if that's the case, which I hope it's not, then the question becomes, can the Fed control rates? Can they rise, and can they stop the rise, or will they stop the rise before getting into the very uncomfortable period that followed that rise in the late 70s? So this then gets back to, for me, the question at the beginning of, is it advisable to refinance now when the borrowing rate is likely to be well into the 5s, maybe into the 6s on a short-term basis? And it obviously depends on it, to a certain extent. It depends on what an owner or borrower feels about what's coming next. But the approach that I have tried to advise is to focus on the asset and the game plan and the hold period. And if the financing that's available in the market is can be supported by the property, then I think on long-term holds, it makes sense to focus on the real estate game rather than the interest rate game. So is it pleasant to refinance now? No. If you refinance now and treasuries do drop, which I'm rooting for, will you wind up kicking yourself or kicking me? Probably. But I think the alternative in other periods of time has been worse. And the downside to not taking advantage of rates where they are can be quite negative. But there is one silver lining that that we can point to. And James, if you go to the next slide, and Jeff Morak gets the credit for creating this too, and I'm going to try to explain it. The sort of simple summary is that prepayment penalties are totally different, need to be thought of totally differently than they have been for the last however many 5-10 years. For many years it's been the case that if a loan had more than 18 months left, it seemed impossible or inadvisable to refinance because the prepayment penalty was so high. The reality is that because of the change in the yield curve, so the blue line here is the yield curve a year ago, and what it shows is that the treasury 2-year treasury rate was dramatically lower than the 10-year treasury rate. Okay, in the 1-year interim, short-term yields have risen by 400 basis points. That's the purple arrow on the left, while long-term rates have risen. They have risen for sure, but by significantly less, 230 basis points. And so now with the purple curve line at the top, an inverted yield curve, it is the case that it is in a very advantageous, it seems to be an advantageous time to prepay. In fact, we have a transaction we're working on now that has a swap in place on the existing financing. When we looked at it, let's say a year ago, the cost of repaying that loan was very high. The borrower would have to come out of pocket to repay. Now, in looking at it, there is a $5 million payment that will come to the borrower from breaking that swap and repaying. And so we're in a scenario where any prior assumptions of prepayment penalties need to be thrown out. And it is very important to look, or we can look for you, but to look at the cost or benefit of repaying existing financing. If it's a defeasance or swap structure, then it is possible that there is a positive payment to the borrower. And if it's yield maintenance, it's probably down to a minimum of a point or half a point. And this is down from payments that could have been as high as 10% of a loan amount. And so while that won't entirely offset the pain of borrowing in the 5s and 6s as opposed to the 3s, it may soften the blow. So that is a silver lining that we're pointing to, and something that can change the metric on some deals. If where an owner has a concern that rates may rise or liquidity may dry up, this can help in moving forward to that next step. So James, that's those are the slides we had prepared. Happy to continue to chat.
Thank you, Scott. That was very enlightening, a little bit scary, but I think you definitely painted both sides of the picture there, and some opportunities as well, which I think is great. Definitely, if you have questions, go ahead and put them in the Q&A, or I see we have some in the chat as well. So I will I'll dig into those momentarily. But Scott, I had a question for you, and I know we talk a lot about this in our group meetings in the morning, but with these rates going up, it's not just a function, unfortunately, of the debt being more expensive, but what that's also doing is putting downward pressure on the amount of proceeds that are available. So I think, and a lot of our listeners are investors who love the idea of, distress and, finding opportunities where someone has to sell. And so maybe talk a little bit about the type of proceeds, loan to value, loan to cost, because there is, certainly a correlation there as these rates continue to go up and banks become more conservative, that when borrowers go to refinance, unfortunately, with a lot of these, they're going to have to pay down this debt or figure something else out.
Yeah, I think there's clearly a challenge in the market for borrowers who were pushing the leverage levels on loans. And so, yes, that's an opportunity for others potentially. Lenders instituted some changes as rates got very low that will turn out to have been helpful. So earlier in my career, before rates dropped to the 1.5% treasuries, the typical metric for sizing loans was debt service coverage. And which was historically a strong and helpful metric in preventing loans from getting too large. When the treasury dropped to its all-time lows, every loan of any sizing would be possible to achieve on a debt service coverage basis. And so the lending community smartly moved to the metric of debt yield. And debt yield is not driven by the borrowing rate, but rather by comparing the net income to the loan amount. And so I think that sizing on debt yield will turn out to have been helpful, although with tremendous amounts of liquidity coming in, debt yields decreased significantly. So the traditional metric earlier in my career was the amount that could be borrowed was what was equal to 1.25 coverage of an 8% constant, which equates to 10 times the NOI. 10 times the NOI equals a 10% debt yield. And had borrowing amounts fixed at 10% and not changed, then debt yield would have worked entirely as intended. But mortgage brokers and borrowers and others pushed, and there was a need to produce, and debt yields got as low as, say, 6.5% or even 6% on sizing, which did create large loans. And certainly there's a significant segment that will be challenged now, because while lenders mostly switched to using debt yield as the constraint, debt service coverage ratios remained as a second metric on virtually all transactions. And now with the higher rates, as we revert back to being constrained by debt service coverages, the loans are going to be smaller, right? So it's a long-winded way to say new loan sizings are smaller in most cases. So from a existing borrower's perspective, fixed rate loans were generally long duration. Rates were very low over the last few years, and borrowers who took advantage of those low rates have a cushion without refinancings coming due. But I think that where there are challenges for borrowers and opportunities for buyers are in the nearer term duration.
Great answer. And I know the other thing we've been talking a lot about is how to solve for that gap equity that's going to be required. So, and you always see this where there's challenge, there's opportunity. And so we see a lot of, pref and mezz, funds that are starting to figure out, looking to solve for this. I know one of the questions, and I started talking about distress. Is there distress yet? I mean, obviously broad questions. So you got to, talk about, if we're just talking about New York and by asset class, we have not seen, the floodgates open here by any capacity with loan sales. I mean, certainly here and there, and we've been working with some of the private lenders to sell off some of their loans, mostly, still looking for par or very close to it. But it wasn't like in 2010 when, a lot of these construction loans just went bust, and there was, from some of the big banks, massive write downs. So we just haven't seen it yet. It also seems to me that, yeah, in the past, pretend and extend kind of worked. Everybody's waiting for this return to office and thinking, can things get better? But I think office is going to have some real structural issues, especially for that, class B and C stuff that's just obsolete now with that flight to quality. So I think that's what really underscores the need to figure out, how to repurpose it. But we also got a question on what type of cap rates are we seeing out there? For multifamily, you did see in the presentation that there has been upward pressure, that we are seeing cap rates now in the high 4% range. We have a lot of buyers out there today who do not want to take on negative leverage. And Scott, as I was looking at your, 20-year picture, I was thinking back, to 06, 07, when, the rates were higher, but investors were willing to take on negative leverage because of that unbelievable upside that was perceived in the market. A lot of that was kind of geared at some of the rent regulated apartments that you used to be able to decontrol. We'd see investors buy those at 3 caps, even though they were borrowing money at 6. I do not see as many investors today willing to take that on. They want to, at least get neutral leverage. Office caps, again, they seem like they've held because there's been so few sales. Most of the stuff that's selling is the core, fully leased stuff, kind of like mid to high 4 cap range. And then you have on the other side, completely vacant, but, have not seen any, super high cap rate deals yet for office, but we are starting to see certainly more yield on the retail side. So Brent, maybe you could talk about some of the retail cap rates that we've been experiencing as of late.
Yeah, sure. We touched on it a few moments ago, but certainly the new benchmark is a 6 cap figure. I mean, I wish for all the owners out there, we could tell, have a little bit of a better story, but it really is 6 cap, and it's probably going to tick up from there. What I do think is interesting though is, now that we're through COVID, how will the market analyze and interpret these new retail leases that are signed? Because now I think there's a story to be told that some of these newer leases are going to be perceived as under market, under market in the next few quarters and few years. And I think it'll be interesting to see, where yields move, once sentiment sort of settles in. But we had such a long period of time, whether it was COVID, whether it was right before COVID, and even, even up to a few months ago, I would say, where almost every retail lease was considered an above market lease. And so buyers were adjusting accordingly. But I would say, run of the mill, I think the 6 cap is the number for retail. And in certainly instances, it can and will go higher. We'll go higher than that.
Thank you. We have a question about ground leases. Are they becoming more prevalent and more attractive? And the person writing in said, since they represent a third of the capital and can allow investors to lock in much lower cash costs for that portion of the capital. So, Scott, maybe, we've certainly struck a lot of ground leases, and the benefit, yes, is that you don't have to come, with that amount of capital up front. And for development, yes, it can be interesting. But then, you're looking to build a rental as opposed to a condo. I guess you could build for co-ops, but there's a whole business out there now where institutional investors like iStar are bifurcating the fee from the leasehold and hoping to kind of solve for that. And it's got, in many cases, I don't know if you've seen this on your side, but it also almost becomes a cheaper way to to finance. So curious your thoughts on that.
Yeah, it's interesting. So we have used that. It's interesting that it became a big new business, in the last few years. And I think that Safehold in particular really created it as didn't create it, but expanded it and brought wider recognition that over the long term, we have used that as a solution in other markets at other times, and it seemed more esoteric in the past. The challenge is that with the rise in all both short and long term rates, the question is how inexpensive will those ground lease payments be, and what increases will be necessary in order for the money that's been raised to make those investments, what will those funds accept before? So there have been times it was, we use structures like this in 06, 07 period, but you could bring the essentially, if you think of a ground lease as very long-term financing, you could bring in a market that was borrowing senior mortgages at 5.5–6%, because of the expectation of growth, you could structure some of those at going in cap rates of 1.5 or 2%, and that was hugely accretive to value. Whether that'll be the case going forward is, I think, very much on to be determined, and dependent on where all of these other options and rates go. I see
Great point.
I see a question with regard to best rates available now, and I'd say, look, the 10-year treasury sits around 4%. I'm looking at it on the screen here, and the 5-year is at 4.1, 4.2. Spreads have risen a bit as well. It really depends on the lender and the product type. But I would say that whereas a year ago, let's say the treasury rate would have been hovering in the 1.5 to 2 range, and spreads were ranging from a low of about 110 to say 150 for the most aggressive, as the absolute bottom of the market. Today, we're looking at those treasuries around 4 and spreads that at an absolute low would be in the, let's say, 135, 140 range, with far more of the market in the 175 plus range on spreads, and many deals that are requiring spreads of 250 to 300. So there's more arbitrage in the pricing of deals than we've seen certainly since let's say late 2009 and 2010, and it is very much deal specific, lender specific, situation specific, but I don't see any fixed rate options for borrowing below the 5.25 to 5.5 range for as long as treasuries stay. Now I keep glancing over at the screen because sometimes in the course of an hour there's a 25 basis point spread these days, but that hasn't happened now. And on the floating rate side, going back to that chart that showed the rapid changes in LIBOR over time, we've gone from essentially zero as the short-term index rate to almost 3.5%. So similarly, it's not significantly less expensive to borrow, or less expensive at all to borrow short term now.
Thank you, Scott. We had a quick follow-up question on cap rates for multifamily. What if half the units are market rate and the other half are rent regulated? I mean, look, with regulated units right now, with the inability to decontrol and go to a market rent, and even with combining units, now the DHCR is questioning whether or not this idea of establishing first rents by creating a new apartment size. So this is just putting more challenges for rent regulated. So if you ask most investors, they would tell you, if it's rent regulated, the cap rate needs to be in the 6 cap range, mid 6s. But then I'm not seeing those. We aren't seeing those trades. I mean, on the multifamily side, it's really a question of, well, is there upside, right? So if we're still seeing 4 caps, mid 4 caps for multifamily, if there is immediate upside for those fair market units. If you're telling us, hey, the fair market units, this is a stabilized asset, meaning completely improved, rents are maximized, then yeah, investors today, based on what Scott's saying, are probably going to be looking for low to mid 5 caps. So if you're talking about a blend, that's probably going to push that well into the high 5 range. And in the boroughs, you might very well see cap rates in the 6s. I think we'll do one. We've got two more questions here. And Arthur, thank you for asking about, are we seeing an impact of, crime on transaction volumes and values. I think it's difficult to make a direct link there. I think it's certainly something that the quality of life, which is on New Yorkers' minds, and we are hoping that as we have a return and more people out there on the streets, that quality of life is improving. Hopefully more police presence out there, but yeah, difficult to say. I mean, we haven't seen a drop or any concerns or lost any sales because of crime, but we'll certainly keep an eye out. But last question, asking about, are there still big sales being announced? And if so, were they signed up a couple months ago, or are they just closing now? Reference to 175 Water Street at 252 million. Look, I have no doubt that several of these certainly were in the works for the last few months. And I think the key, as Scott, has said, is that when buyers go in, they have to be conservative and understand that if the proceeds, they need to contribute more equity to a deal, that they're willing to do that. We're actually getting ready to sign a deal right now downtown where the buyer might take less than 50% leverage, especially, if rates keep up. So
yeah, I would say, James, that just to kick in on that, I'm not sure that it is as relevant as it seems whether a deal was negotiated in the past, because the reality is where deals are uneconomic now, buyers are not James's buyers, but some buyers are walking from deposits. And I think when you see a deal that trades now, regardless of when it was negotiated, that is a decision now to spend the rest of the, say, 90 or 95% of the cost. And I think that all trades now should be viewed in a positive in a positive light. It's rare that given the volatility that has existed in the market, deposit is not necessarily enough. The transaction had to have made sense to move forward. So we are both simultaneously hearing about new contracts being signed based on this new paradigm, and old contracts both closing and not closing based on it. So I think the market now is a rational, functioning, challenging but active place. And I think that we should be celebrating the closings that are occurring as an indication of that, regardless of when they started, because we have certainly heard of some very large deposits also being walked from. And I think we're out of a period of time when the expectation is that all transactions close smoothly and easily, and the thought of walking from a deposit was really unthinkable and a major failure. I think that the deals that were signed up, that were negotiated previously, are being rethought, and if they're closing, it's because there's sense in that price.
And when selling, I think certainty of execution is paramount. And sometimes the highest offer that you have is not the best offer, because you want the offer that's going to stick and it's not going to get retraded during contract negotiations, or have one of those unfortunate situations like Scott mentioned where a buyer walks from a deposit. You want to make sure that they have realistic expectations going in, and again, the amount of equity that they're going to have to bring to the table. So I'll answer, sorry, one more quick one, and then we'll call it, just because if I wasn't clear on the update for the 421A, and you probably remember up in Albany, they were trying to pass 485W that would have required even deeper levels of affordability, and that could not get done. Everybody I'm talking to is saying that this is going to have to wait for after the elections. It's just too much of a hot potato issue, but certainly they'll get right back on the docket, because as we said before, without some type of tax abatement, we've seen rental land sales come to basically a screeching halt. So we want to thank you all for joining. If you'd like a copy of this presentation, feel free to email us, or any follow-up questions. We love hearing from you. Hope this was helpful, and we will certainly be looking forward to seeing what transpires over the next couple of months. But I would I think the last thing I would say is one of our fellow principals, Brandon Polikoff, wrote a nice white paper that you can find in Real Estate Weekly about, staying attentive, staying in the market. I think, one thing is when there's transition like this, sometimes the sense is I'm going to just sit here on the sidelines and then miss opportunities that come up. And so it's great that you all are showing up and listening to this. And I would encourage you all to continue to stay out there looking for opportunities, because you never know when they're going to strike. So thank you again. Thank you, Scott. Thank you, Brent. And we look forward to being in touch.
Thanks, James. Bye, everybody.
Thank you.